Here's how you can craft a robust dividend portfolio that not only offers a steady stream of dividend income, but also has the potential for growth over the long haul. In this piece, I'll walk you through the process of building a well-diversified dividend portfolio that combines both consistent income and growth potential. I'll use the Dividend Income Accelerator Portfolio as an example to illustrate how it strikes a balance between dividend income and growth, positioning itself to potentially yield positive investment outcomes. Even though this portfolio is still in its developmental phase, consisting currently of 1 ETF and 12 individual companies, it already presents a compelling mix of dividend income and growth. Its composition aims for balance and diversity across various companies, sectors, industries, and geographical locations, making it a robust investment vehicle. The portfolio's strength doesn't just stem from its diversification. This comprehensive risk analysis paints a picture of the portfolio's lowered risk level, boosting the likelihood of favorable investment outcomes. Currently, this portfolio provides a weighted average dividend yield, TTM, of 4.69% and a 5-year weighted average dividend growth rate, CAGR, of 9.03%. These figures underscore how effectively the portfolio combines income with growth, making it an attractive choice for investors seeking a balanced approach to dividends. The Dividend Income Accelerator Portfolio currently holds a diverse set of positions in several well-known companies across various sectors and industries. These include Schwab US Dividend Equity ETF, SCHD, Realty Income, O, Philip Morris, PM, Royal Bank of Canada, RY, Apple, AAPL, AT and T, MasterCard, MA, Main Street Capital, Main Johnson & Johnson, J&J, Bank of America, BSC, Ares Capital, ARCC, BlackRock, TCP Capital, TCPC, British American Tobacco, BTI.
Big shout out to Seeking Alpha for sponsoring our video and its analytics. Make sure to get your 14-day free trial of Seeking Alpha Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys.
This portfolio's primary goal is to generate income through dividends, aiming to consistently increase this income annually. Simultaneously, it seeks to achieve an appealing total return while managing risk effectively over the long term. The reduced risk level of the Dividend Income Accelerator Portfolio results from its extensive diversification across various sectors, industries, and companies with a low beta factor, indicating less volatility. Here are the key characteristics of the Dividend Income Accelerator Portfolio: attractive weighted average dividend yield, TTM, attractive weighted average dividend growth rate, CAGR, over 5 years, relatively low volatility, relatively low risk level attractive, expected reward, represented by the expected compound annual rate of return diversification across asset classes, sectors, industries, and countries, buy and hold suitability. The table provides an overview of the companies included in the Dividend Income Accelerator Portfolio, showcasing their symbols, names, sectors, industries, countries, forward price-to-earnings ratio, FWDPEE, dividend yield, TTM, dividend growth over 5 years, number of shares, acquisition price per share in dollars, total acquisition cost, current price per share in dollars, market value, and current allocation. This detailed breakdown offers insights into the composition and status of the portfolio's holdings. Take a glance at the chart below, displaying the 60M beta factors of the companies in the Dividend Income Accelerator Portfolio. About half of the 12 individual positions in the portfolio showcase a 60M beta factor under 1. These low 60M beta factors signal that these companies could contribute to lowering the portfolio's volatility, suggesting a relatively lower risk level for investors. Key contributors to this reduction in portfolio volatility include British American Tobacco, 60M beta factor of 0.33, Johnson & Johnson, 0.58, AT&T, 0.71, Royal Bank of Canada, 0.79, Philip Morris, 0.8, and Realty Income, 0.87. Chart showing 60M beta factors. Source: the author, data from Seeking Alpha. The recent addition of British American Tobacco to the portfolio notably bolsters the reduction in volatility and risk level. Refer to the chart below illustrating the payout ratios of the companies in the Dividend Income Accelerator Portfolio. Among the 12, 10 companies maintain a payout ratio under 80%, highlighting the portfolio's decreased risk level. A lower payout ratio implies room for potential dividend increases. Conversely, a high payout ratio could indicate a higher chance of a dividend cut, posing a risk for investors. Within the portfolio, Apple boasts the lowest payout ratio, 15.36%, followed by MasterCard, 19.44%, Bank of America, 25.21%, Johnson & Johnson, 44.23%, AT&T, 44.76%, and Royal Bank of Canada, 47.90%. Only Ares Capital, payout ratio of 80.67%, and Philip Morris, 84.60%, surpass the 80% threshold. This reaffirms the decision not to overweight these stocks in the portfolio, mitigating risk and enhancing potential performance. Analysis of EPS growth rates. Now, examine the EPS growth rates of individual companies in the Dividend Income Accelerator Portfolio shown in the chart below. 9 out of the 12 companies demonstrate positive EPS growth rates, with 4 exhibiting double-digit rates: Realty Income, 20.49%, MasterCard, 19.23%, Main Street Capital, 13.59%, and BlackRock TCP Capital, 12.89%. Only 3 companies show negative EPS growth rates: AT&T, 9.72%, Bank of America, 2.80%, and Royal Bank of Canada, minus 1.06%. These metrics clearly indicate the company's dedication to delivering value to their shareholders. They also provide an added confirmation that the Dividend Income Accelerator Portfolio maintains a lower risk profile, thereby increasing the likelihood of generating positive investment outcomes. Analyzing risk. Diversification within the Dividend Income Accelerator Portfolio. Across companies ETF. At present, the Schwab US Dividend Equity ETF holds the most significant position within the Dividend Income Accelerator Portfolio, making up 43.5% of its composition. Among individual companies, Bank of America holds the largest share at 5.26%, followed by Apple at 5.07% and AT&T at 4.99%. The payout ratios of these top 3 positions are notably below 50%, reinforcing the notion that this portfolio offers investors reduced risk. Bank of America's payout ratio is at 25.21%, Apple's at 15.36%, and AT&T's at 44.76%. These figures indicate a lower likelihood of dividend cuts for the 3 largest positions within the Dividend Income Accelerator Portfolio, aligning with the portfolio's reduced risk profile, as discussed earlier. The graphic below visually outlines the current distribution of the Dividend Income Accelerator Portfolio by allocating the Schwab US Dividend Equity ETF across its invested companies. Careful consideration has been taken to ensure that the individual companies I've selected are distinct from those already within the Schwab US Dividend Equity ETF. This strategic approach minimizes the risk of overconcentration in specific companies. Notably, even with the allocation of the Schwab US Dividend Equity ETF across its invested companies, only Bank of America, 5.26%, and Apple, 5.07%, account for over 5% of the total investment portfolio. The remaining companies all hold less than a 5% share, signaling a decreased concentration risk specific to any single company within the Dividend Income Accelerator portfolio. Additionally, it's essential to highlight that the companies currently comprising less than 2% of the overall portfolio are indirect investments facilitated by the inclusion of the Schwab US Dividend Equity ETF. The graphic specifically features the 20 largest positions within the Dividend Income Accelerator portfolio, encompassing 12 individual companies and the 8 primary positions of the Schwab US Dividend Equity ETF. Analyzing risk, the Dividend Income Accelerator portfolio's sector diversification. Presently, the ETF sector constitutes the largest sector within the Dividend Income Accelerator portfolio, comprising 43.5% of the total portfolio. Following closely, the financial sector holds the second largest share, representing 28.3% of the portfolio. Notably, this sector is represented by Bank of America, BlackRock TCP Capital, MasterCard, Main Street Capital, Ars Capital, and Royal Bank of Canada. The consumer staples sector claims 9.1% of the portfolio, represented by British American Tobacco and Philip Morris, while the information technology sector, predominantly represented by Apple, accounts for 5.07%. Furthermore, the healthcare sector, chiefly represented by Johnson & Johnson, constitutes 4.52% of the portfolio. The real estate sector, represented by Realty Income, and the communication services sector, represented by AT&T, both hold 4.48% and 4.99%, respectively. While the ETF and financial sectors command the most significant portions of the portfolio, other sectors maintain smaller shares, each constituting less than 10%. However, the extensive representation of the financial sector does present a level of sector-specific concentration risk within the overall portfolio. Moving forward, the financial sector, 28.32%, Bank of America, 5.26%, BlackRock TCP Capital, 4.77%, MasterCard, 4.74%, Main Street Capital, 4.69%, Ares Capital, 4.59%, Royal Bank of Canada, 4.27%, Consumer Staples, 9.08%, British American Tobacco, 4.57%, Philip Morris, 4.51%, Information Technology, 5.07%, Apple, 5.07%, Communication Services, 4.99%, AT&T, 4.99%, Healthcare, 4.52%, Johnson & Johnson, 4.52%, Real Estate, 4.48%, Realty Income, 4.48%. Analyzing risk, sector allocation of SCHD. The chart below presents the sector allocation facilitated by the Schwab US Dividend Equity ETF within the Dividend Income Accelerator portfolio. Currently, the financial sector dominates the portfolio, constituting 35.31%. This prominence signifies a level of sector-specific concentration risk. Following this, the consumer staples sector holds 14.64% of the portfolio, trailed by healthcare, 11.38%, and information technology, 10.19%. Sectors such as industrials, 7.84%, and communication services, 7.42%, carry considerably less weight within the portfolio, each amounting to less than 10%. Sectors like real estate, 4.49%, energy, 3.96%, consumer discretionary, 3.95%, basic materials, 0.84%, and utilities, 0.16%, have minimal representation, each accounting for less than 5% of the overall portfolio. This distribution indicates a lessened risk level for investors. Looking forward, the Dividend Income Accelerator Portfolio aims to broaden its diversification by incorporating additional companies in the coming weeks. This strategy aims to mitigate the current sector-specific concentration risk associated with the financial sector's predominant presence within the portfolio. The graph below breaks down how our investments are spread across various sectors. It's clear that the ETF industry holds the biggest chunk, accounting for 43.5% of our investments. Next up is the asset management and custody banks industry, making up 14.1%. This slice represents companies like BlackRock TCP Capital, Main Street Capital, and Ars Capital. The diversified banks industry follows, taking up nearly 10% of our investments with Bank of America and Royal Bank of Canada as its key players. Tobacco, represented by British American Tobacco and Philip Morris, comprises 9.1% of our investments. The technology hardware, storage, and peripherals industry, spearheaded by Apple, stands at 5.07%. All other industries make up less than 5% individually, emphasizing that our portfolio has diversified well across various industries, reducing risks. The portfolio predominantly consists of US-based companies, amounting to 91.1% of our investments. However, we've allocated 8.9% of our portfolio to companies outside the US, such as British American Tobacco from the UK and Royal Bank of Canada from Canada. This geographical mix aims to reduce risks associated with a single location. Analyzing the allocation across equity styles after applying the Schwab US Dividend Equity ETF, we find that 71% are large-cap companies, 18% are mid-cap, and 11% are small-cap. Moreover, 56% of our portfolio comprises value companies, 34% combine value and growth, and 10% are growth companies. These indicate a deliberate focus on large-cap and value companies, a strategy to lower risks. Our portfolio mix presents an appealing blend of dividend income and growth, backed by reduced risks due to diversification strategies. With a consistent investment plan and further diversification efforts, we believe our portfolio has a high potential for attractive outcomes, making it an excellent choice for those seeking dividend income with reduced risk.